Want to do a series. I mean, we've already done some sessions on options and how to get to their pricing. I want to do a little bit more on that because I really want to get into more of the details um, on what exactly you're pricing out when it comes to an option. And there are certain laws and certain sentiments that come with the actual pricing options. And what I want to get to eventually is because we've been talking about using, binomial, the binomial model to actually come up with the pricing. But if you take the binomial model and you know, in, decrease the durations down to nothing, basically, you then get to another model, which is called the Black-Scholes model. And so what I want to be able to do with these sessions is not only have you better understand, uh, what's included in the pricing and, and why you do certain things with the pricing or to get to the pricing, but then bridge the binomial model to the Black-Scholes model. And there are some differences, obviously, even when you go to the integrity, especially when it comes to, to get it to the Black-Scholes, you do lose a little bit of fidelity on certain things that you can actually do with the binomial model to actually price out just about any type of scenario. Whereas with the Black-Scholes, it gets a little bit harder to actually do some of the outer cases that you may want to do. So, but either way, we'll go through all that, we'll discuss all that, and I'll explain all that um, so that you actually have a good grasp. Without going into every little detail, I do want to get into some details because it's important, especially on some of the calculations, just so that you see what they're doing, but we won't get into every little detail. And I just want to cover a couple of things on this session. Basically, to actually get to the foundation of it. So, why do we need, why options need pricing models? Because when you're dealing with cash flows or future flows of money, and there's a little bit of uncertainty to those cash flows, it's very hard. It's very hard to determine what those cash flows are actually worth today. And especially when you throw in the time element into it. And so you need to have models. You need to have models that actually um, that are, keep a lot of some of the assumptions that we have, especially on what we expect to happen out of it and make them more neutral. And that's why when we talk about the probabilities associated with options, it's the risk neutral probabilities that actually lead to risk neutral valuations, so that you can actually eliminate certain arbitrages. And arbitrage is something that happens when there's mispricings. Now, and I'll just quickly explain that one on this session. So let's say you have two portfolios, one's priced at 100, the other one's priced at 90, but yet their expected future values are going to be 110 for both of them. So that means there's a mispricing there. And so what I could do is to take advantage of that is actually sell one and buy the other one. So I could actually short the higher cost one and buy the lower cost one. I would make $10 right there, and I know what the future value is going to be already. Oh, well, assuming that again, it's most likely going to be that. And that's called an arbitrage because again, they should be priced the same, they should have the same current value because their future value is going to be the same. Again, assuming their future value is going to be the same, then they should have the same current value. Um, and so that's something you don't want to see. You don't want to have that, especially as you're actually, creating pricing around options. And so it's very, very important to price options so there is no opportunity out there for somebody to take advantage because in the end, options are really a combination of what you can do with stocks and bonds. It's really what it is. You can actually create it. A synthetic um, position using of an option using bonds and stock. And so you don't want to be able to have an arbitrage opportunity out there. And so you price things so that there is no mispricings, between the options, what you actually value and put prices on the options, and then the individual stocks and bonds that the value of that option is being derived from. All right, and we'll get into more of those details.